this book. While the basic facts behind each of the detailed investments in this book are accurate, I have forgotten many of the details, such as exact conversations, estimates of revenues and earnings, dates and locations. These I approximated wherever possible, or in some cases pulled from my imperfect memory. In addition, I have taken the liberty of changing the names and backgrounds of some individuals in order to protect their privacy. I have also revised the original letter to Jack Elgart to include additional approaches and strategies and to expand some explanations. I strongly hope that this book stimulates thought about the investment process. Even if the listener does not agree with parts or all of my approach to investing, if the book motivates the listener to think deeply about the science and art of investing, I will feel that the time and effort devoted to writing this book were time and effort well spent. 1. My approach to investing. Note: most of the contents of this chapter will not be new to the majority of experienced investors. I wrote this chapter to bring less experienced investors up to speed with the principles of value investing. In my opinion, good investing largely is common sense, made somewhat difficult by the behavioral imperfections of man. We can start with the straightforward concept that, over the longer term, common stocks are an unusually attractive investment vehicle, even for an investor whose returns only equal the stock market's returns. During the 50-year period 1960 through 2009, the average U.S. common stock provided an average annual total return, capital gains plus dividends, of 9 to 10%. In addition to providing this favorable return, common stocks are highly marketable and therefore can be purchased and sold easily without high frictional costs. Also, and importantly, if selected properly, common stocks offer considerable protection against risks of permanent loss. What could be better? Favorable returns, high liquidity, and relative safety. That is a home run combination, and that is why I am a great fan of common stocks. The 9 to 10% average annual return provided by common stocks over the 50-year period makes economic sense. During the period, if adjustments are made for a few outlier years, the U.S. economy grew at roughly a 6% annual rate, about 3% from real growth, unit output, and about 3% from inflation, increases in prices. Corporate revenues during the period increased in line with the economy, and corporate earnings roughly increased in line with revenues. While the price-to-earnings (PE) ratios of U.S. common stocks have fluctuated widely during the 50-year period, they seem to fluctuate around an average of about 16 times earnings. Therefore, before consideration of corporate acquisitions and share repurchases, common stocks have appreciated at about a 6% average annual rate over the years due to growth of the economy. U.S. corporations, on average, generate considerably more cash than they require to support their growth. This excess cash can be used by corporations to pay dividends, acquire other companies, or repurchase their own shares. Over the past 50 years, dividends have provided a 2.5+% yield, and acquisitions and share repurchases together have increased the earnings per share (EPS) growth of publicly traded corporations by close to 1% per year. Thus, an average company's EPS has grown at about a 6% rate organically and at about a 7% rate including acquisitions and share repurchases. If one then adds in the 2.5+% dividend yield to this 7%, the result is the 9 to 10% total return that an average investor has received over the years from investing in common stocks. While it is difficult to project the future, assuming that the United States continues to be reasonably prosperous and capitalistic, I see no reason why the U.S. stock market will not continue to provide average annual returns of 9 to 10% over the longer run, even if the U.S. economy grows at a somewhat slower pace than it has in the past. If future growth is somewhat dampened, then corporate